Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're going to be looking at BFT and Paysafe, and specifically in this video we're going to be looking at the price targets again. Now in the previous price targets video we looked at the valuation versus its peers. However, this time we're looking at the valuation on the basis of the growth, and ultimately how the market is pricing growth within this sector. As part of this we'll look at what this means for the share price, and we'll also touch on why this makes sense and why it's not unreasonable, and as always certain things we need to be wary of around this. Now, quick spoiler, if you don't want to stick around for the entire video, this equates to a share price of around $42 if Paysafe can execute upon its growth plan, including M&A, or alternatively, if the business was just to grow organically, so no acquisitions, this would imply a share price of around $22. Now, at the point in filming, even the lower end of that target represents an attractive premium to the current market price, and what's more, the growth assumptions underpinning that would imply slower growth than the company's ever grown before. So I think we can take great confidence from this. Now, if you have seen the previous price target video, you'll know that this range also sits very closely in line to the previous valuation range, which is good. It's always very important when coming up with price targets that you triangulate that using as many methods as possible. You really can't rely on just one methodology. Now, as with the previous price target video, this one inherently is more technical in nature. I'll try to break it down and keep it as simple as possible so that everyone can follow it, because if you're invested in BFT or you're thinking about it, this video is definitely one you don't want to miss. If you're new to the channel and you like investing related content, then smash that subscribe button. Now, we have seen some amazing growth on the channel recently. Thank you so much. If we can hit 5,000 subscribers, I've got something really exciting I want to share with you. I've not seen anyone else on finance YouTube do this at all, and I really do believe it could provide massive amounts of value to investors of all levels. So thank you so much so far, and let's try and hit that 5K. Videos like this do take a lot of time and analysis to put together, so it's massively appreciated if you enjoy the video if you could smash the like button. And as always, whilst my full-time office-based job is investing, I'm not a financial advisor. This video is purely for educational and entertainment purposes only. However, as I always say in these price target videos, this is particularly important in these videos. I'm sharing with you my analysis. That's a function of the assumptions I've made. So always, always, always do your own due diligence. But with that being said, let's get straight into it. So in the payment processing sector, given the commoditized nature of the product, the little differentiation between companies' offerings, the sticky customers, the limited propensity for customers to switch provider, and the comparable margins that companies are generating when they're operating at a similar scale, growth, and particularly revenue growth, is one of the key metrics here. When reading the investor presentation, you can see readers being steered towards that, but what is important is to understand how the market values this growth, and ultimately what that means for the stock price of BFT. With this in mind, the analysis I've done has basically looked at the valuation multiples on an EV/EBITDA basis for the forward year, so next year's EV/EBITDA multiples, and determining the correlation between those and the forecast revenue growth. Knowing that correlation and knowing the forecast revenue growth that Paysafe is expected to generate, we can then use that to extrapolate out an implied valuation multiple. That makes it sound a lot more complicated than it is, so bear with me. So the first step of this analysis is understanding the correlation, the relationship between revenue growth and valuation multiples. What I've done is I've taken the key competitors and, using the latest valuation multiples from Seeking Alpha, have updated those from the investor presentation. The next step is then to take the forecast revenue growth for each of these companies and simply plot those in Excel. From here, we run a simple correlation analysis. Ultimately, what this enables us to do is understand whether there is a correlation and the relationship between the revenue growth and how the companies are valued. As you can see from this chart, there is a positive correlation. That means on the basis of this population and the basis of this set of companies, the higher the revenue growth of the company, the higher the valuation multiple, or the more the market values that company. Said differently, the faster growing companies in the sector are those which are valued more highly. Now yes, whilst there are outliers, this still is a strong degree of correlation. In fact, if you were to include Square in this analysis, as you can see from this chart, the correlation is even stronger. However, to avoid the argument that this is an outlier and to avoid people coming at me in the comments, I'm not using the analysis which includes Square. So ultimately, whilst the impact on the share price using either methodology is very limited, I'm sticking with the first peer set because there's less debate around that and people can't argue that there's outliers that are distorting it. So we're using this peer set. And now the next step, using this algebraic equation and knowing what the revenue growth is to determine on the basis of this what the valuation multiple should be. Now the one thing to bear in mind here is that this is on the basis of companies which are trading which are no longer SPACs. Some have never been SPACs, but some have been and they've completed the transition. As we've touched on before, certain investors can't invest into SPACs, whether that be a result of the inherent greater risk in investing in SPACs that the transaction may not complete, or perhaps even the lower levels of financial disclosure which you have within SPACs versus normal public companies. That being said, when thinking about this analysis, we do need to remember that there will be the absence of those investors, and perhaps they do have an impact on this. So I'm not going to bore you with the mathematics here. However, if anyone is interested, then please let me know in the comment section below. I can walk you through that. However, I've looked at it under two scenarios. The first scenario is looking at the company delivering 13% organic growth. This is outlined in the investor presentation and is assuming no acquisitions. Just as a reference point, this would mean the company is growing at a slower rate than it has done historically. And deriving an enterprise value from the EBITDA multiple which that implies, in turn implies a share price of around $22, or to be exact, $21.39. Now, whilst that does represent a premium to the stock price currently, I think most of us would be fairly disappointed if the company was only to deliver this growth. We know Foley's track record, we know his ability to deliver value creation through mergers and acquisitions, and that's definitely part of the plan that we as investors are hoping he will deliver on with Paysafe. So for me, that really does have to be a base case here. So following that logic, we need to give credit for Foley and his team and the incremental growth on top of the organic growth, which they should be capable of delivering. Whilst this is not outlined in the investor presentation, using the historical growth which both CVC and Blackstone deliver within the company, on an annual basis, including the impact of acquisitions, we can fairly reasonably assume that 27% compound annual growth rate as the assumption for our analysis here. As a reminder, Foley's track record has grown companies much faster than this. So as investors, we should definitely hope that Foley does have a clear M&A plan to deliver incremental growth for the business. That being said, using that 27% growth in our analysis implies a share price of around $42, or $41.76 to be precise. Again, this triangulates very nicely to the previous price target video we did, and personally that gives me more confidence that this is around the right level we should be thinking. However, it goes without saying, this is all on the basis of growth. If the company is unable to deliver on this growth plan, it will imply a lower valuation. If it's able to exceed those growth expectations, it would imply a higher valuation. It really is that simple. Now, one very important thing to bear in mind here, and I feel we do discuss it in every BFT video, is about the lockup, both for the private equity investors, Blackstone and CVC, and for the PIPE investors. So if you haven't seen my BFT video specifically on the lockup period, then I recommend you check that out too, because ultimately, at some point in time, it will have an impact on the valuation. Ultimately, the unknowns here really are around at which point in time following the expiration of the lockup that will be impacted, and for what period of time that will be felt for. But look, thank you so much for watching. I hope you enjoyed the video. If you did, please hit the like button. If you're new to the channel and you like investing related content, then hit that subscribe button. And as always, please let me know your thoughts and comments in the comment section below. There's also some really interesting debates, discussions, and opinions raised, which I love hearing about. So please get involved. Thank you so much for watching, and I'll see you in another video.